There's a pattern in the data that took a while to see clearly. The people who accumulate the most wealth over 20 and 30-year periods don't use the most sophisticated tools. They don't have the best spreadsheets or the most detailed budgets. In most cases, they follow fewer rules than everyone else, not more, fewer. And the rules they follow are so simple they could fit on a single index card. That observation is the starting point for everything in this video. Last video, we wired the payday routine. The mechanical layer. Today is the philosophical layer underneath it. I'm Warren, and the thing that keeps emerging from these numbers, video after video, is that the biggest threat to building wealth isn't ignorance, it's complexity. The more decisions a system requires, the more likely it is to collapse under its own weight. And most financial advice adds decisions, more categories to track, more apps to check, more rules to remember. What if the answer is the opposite? What if the best financial system is the one with the fewest moving parts? Her net worth crossed $200,000 at 34. She follows exactly 5 rules. Her name is Adriana. She works as a veterinary technician in Boise, earns about $58,000, and has never once used a budgeting app. No spreadsheet, no expense tracker, no monthly review of categories and allocations. When asked how she manages her money, she said, "I don't manage it. The rules manage it. I just don't break them." That answer sounds too simple to be real. It isn't. The research on decision fatigue, going back to the work of behavioral psychologists in the early 2000s, shows that every decision a person makes during the day draws from a finite reservoir of mental energy. Financial decisions are among the most draining because they involve trade-offs, uncertainty, and often guilt. Think about what a budgeting app actually asks the brain to do. Categorize every purchase, review spending weekly, compare actual to planned in a dozen categories, make adjustments, decide whether the coffee was dining or groceries. That's dozens of micro-decisions per day added to a brain that's already managing a job, relationships, sleep, and everything else. Over weeks and months, compliance drops. Not because the person is lazy, because the brain runs out of capacity to care about the difference between a $4 coffee in the dining column versus the grocery column. Adriana's approach is the opposite. She makes 5 decisions once. Then she never makes them again. The rules run on autopilot, and the compound effect of 5 simple rules followed without exception for 10 years produces results that no amount of spreadsheet optimization can match. Here's what those rules are, and here's what each one is worth. Rule 1. Automate before you see it. This is the payday routine from the last video, compressed into a single sentence. The moment income arrives, a predetermined percentage moves to savings, debt payoff, and investing before the checking account receives the rest. Adriana set her split deposit at 20% to building, 80% to living, on the day she started her job at the veterinary clinic in Boise. She called the payroll administrator, asked how to set up a split deposit, and had it running within a week. She's never adjusted the split downward, only upward, twice after raises. The rule isn't complex. It's binary. Money arrives, money splits. No decision required on payday. No temptation to skip this month because rent was high or because a weekend trip to McCall is coming up. The system doesn't negotiate. It doesn't ask how the person feels. It just runs. Here's why this rule matters more than the other 4 combined. If you only follow one rule from this video and ignore the rest, make it this one. Automation removes the single biggest point of failure in personal finance. The moment between receiving money and deciding what to do with it. That moment is where every budget dies. That moment is where the brain rationalizes exceptions. That moment disappears entirely when the split happens before the money lands in the spending account. The 10-year math, 20% of $58,000 is about $11,600 per year. At 7% average return, invested consistently, that's roughly $160,000 in 10 years. Not from stock picks, not from timing the market, from a split deposit that runs on autopilot every 2 weeks. Adriana didn't make $160,000. She made a phone call to payroll. The compound interest made the $160,000. Rule 2. If the interest rate is higher than 7%, pay it before investing. This is the debt versus market decision from video 7, reduced to one line. 7% is the long-term average annual return of the stock market. Any debt charging more than that is costing more than the market is likely to earn. The math is binary. Adriana had a small car loan early in her career at about 5%. She didn't rush to pay it off. She made the standard payments and invested the rest because 5 is lower than 7. But when a medical bill from an emergency vet visit ended up on a credit card at 21%, she paused her Roth contributions for 3 months and threw everything at the card. The rule told her what to do without debate. 21 is higher than 7. Pay it first. 5 is lower than 7. Invest around it. No spreadsheet needed. No late-night calculations about opportunity cost. The hidden power of this rule is that it removes the most paralyzing financial question most people face. Should I pay off debt or invest? That question generates hundreds of hours of YouTube content and thousands of Reddit threads. It drives people to spend weeks researching before doing anything at all. And the answer, every single time, collapses into one sentence. Compare the rate. Act accordingly. If the debt rate is higher, pay the debt. If the investment return is higher, invest. The sentence never changes regardless of the amount, the type of debt, or the person's income. One rule, one comparison. Done. Rule 3, never sell in a down market. This rule has no formula behind it. It has history. Every major market decline in the last 100 years, every single one, eventually recovered. The S&P 500 dropped roughly 34% in early 2020. By the end of 2021, it had recovered and surpassed its previous high. The people who lost money in that decline weren't the ones who held. They were the ones who sold. Selling during a crash locks in the loss permanently. Holding through it costs nothing except discomfort. And discomfort, unlike a realized loss, is temporary. Adriana's version of this rule was tested in 2022, when her Roth IRA dropped by about 18% over several months. She opened the Fidelity app one evening in October, saw the number, and felt her stomach drop. Her impulse was to move everything to cash. She didn't. She closed the app, went to the kitchen, made a cup of chamomile tea, and didn't look at the account for 6 weeks. By the following spring, the balance had recovered. Not because she did anything smart, because she did nothing. And doing nothing, in a down market, is the smartest thing a person can do. If you've ever felt that impulse during a market drop, the urge to protect what's left by pulling out, this rule exists to override it. The rule is simple. When the market falls, the only correct action is inaction. The brain screams sell, the data says hold. The rule sides with the data. Every time. Rule 4. One raise, one increase. Every time income goes up, the automated savings percentage goes up by at least 1 point. Not the dollar amount. The percentage. Adriana started at 20%. After her first annual raise, she moved to 21. After a promotion 2 years later, 23. She's now at 25%. She never felt the increases because each one was paired with a raise. The higher paycheck absorbed the higher percentage, and the remaining take-home was roughly the same or slightly more each time. This is the adaptation defense from Video 3 packaged as a single rule. Hedonic adaptation wants to normalize the new income. Every raise creates a window of about 2 months before the brain adjusts to the higher number and starts spending accordingly. This rule captures part of the raise before that window closes. One raise, one increase. No negotiation, no debate about whether this is the right time or whether the budget can handle it. The percentage moves the day the raise takes effect. If you've ever gotten a raise and 6 months later wondered where the extra money went, this is the rule that solves it. The 10-year effect of this rule, on top of the base 20%, adds roughly $22,000 in additional compounded value compared to keeping the percentage flat. From a 1-point increase applied 2 or 3 times over a decade. The increments are tiny. The compound result is not. Rule 5. The 24-hour rule for any purchase over $200. Before buying anything that costs more than $200, wait 24 hours. Not to think it over. Not to research alternatives, just to let the impulse decay. Behavioral research on impulse spending shows that the desire to purchase drops by roughly 40 to 60% after a 1-day delay. The item doesn't become less available, the brain simply moves on to other things. Most impulse purchases over $200 never get made when a 24-hour buffer exists. The ones that survive the wait are the ones that were actually needed, and those purchases feel better too, because there's no guilt attached. Adriana described this rule as the one that saved her more money than any other. Not because individual purchases were expensive, but because the frequency of near purchases was higher than she expected. A jacket on sale at Nordstrom Rack, a new set of cookware from Williams-Sonoma, an upgraded phone case that cost $240 for reasons she still can't explain. She said the 24-hour rule stopped roughly 3 out of 4 of those purchases. Over a year, she estimated it saved her between $2,000 and $3,000. Over 10 years, invested at 7%, that's roughly $30,000 to $40,000. From waiting, not from sacrifice. From the simple act of putting 24 hours between the impulse and the action. If you look at your own spending over the last 3 months, you'll likely find at least 2 or 3 purchases over $200 that felt necessary at the time and feel irrelevant now. That's the gap this rule closes. Not by saying no, by saying not yet. And not yet turns into actually no about 75% of the time. Here's the observation that ties all 5 rules together, and it's the reason this video exists as a standalone piece rather than an appendix to the payday routine. Rules are not the same as plans. A plan says, here is what to do in this specific situation. A rule says, here is what to do in every situation of this type. Plans require interpretation. Rules require compliance. Interpretation is expensive. It uses cognitive energy, introduces variability, and creates opportunities for the brain to rationalize exceptions. Compliance is cheap. The rule is the rule. Follow it or don't. There's no gray area, which means there's no negotiation, which means there's no fatigue. The people who build wealth consistently over decades aren't the ones with the best strategy. They're the ones with the fewest decisions between them and the right behavior. Adriana doesn't have a financial advisor. She doesn't read market commentary. She doesn't rebalance her portfolio quarterly or check her Fidelity app daily or debate whether to increase her contribution by $50 this month. She has 5 rules on an index card taped to the inside of her kitchen cabinet. She follows them. And her net worth at 34 on a veterinary technician's salary in Boise is higher than most people's at 45. There's a question in that observation that's worth sitting with, and it's the question this entire video has been building toward. If 5 rules on an index card outperform sophisticated systems used by people earning twice as much, what does that say about the role of complexity in personal finance? Maybe complexity isn't a tool. Maybe it's a trap dressed as a solution. Maybe the spreadsheet and the 17-tab budget app and the weekly financial review aren't solving the problem. Maybe they are the problem. Because every hour spent optimizing is an hour the system could have been running on its own. And the rules don't need optimizing. They just need following. There's a reason Adriana's index card is taped to the inside of her kitchen cabinet and not saved in an app. She sees it every morning when she reaches for a coffee mug. It doesn't require a login. It doesn't send notifications. It doesn't gamify her spending or give her a score for being on budget. It's 5 lines of text on a 3x5 card, and it's been there for 8 years. The technology behind the most effective financial system she's ever used is a piece of paper and a piece of tape. Everything else, the split deposit, the Roth IRA, the Fidelity account, those are just pipes. The card is the blueprint. And the blueprint hasn't changed once. That's the reframe. Simplicity isn't the absence of a strategy, it's the highest form of one. The people who look like they're not trying are the ones whose system requires the least effort to maintain. And the system that requires the least effort is the one that survives the longest. Every complicated system eventually gets abandoned. Every simple rule eventually becomes a habit. And habits, unlike apps, don't get deleted. 3 portfolios, specific ticker symbols, 20 years of backtesting. That's what comes next. Not philosophy. Concrete allocations for 3 risk levels with names and numbers you can copy into a brokerage account tonight. The rules from today tell the money where to go. The portfolios from the next video tell it what to become.